Implementing effective stop-loss and take-profit strategies in Forex. Introduction. Implementing effective stop-loss and take-profit strategies is crucial for successful Forex trading. Stop-loss and take-profit orders are risk management tools that help traders protect their capital, minimize losses, and lock in profits. By using these strategies, traders can manage their risk exposure and increase the overall consistency of their trading performance. In this text, we will explore the importance of stop-loss and take-profit orders in Forex trading and discuss various strategies for their effective implementation. Understanding stop-loss orders. A stop-loss order is an instruction to close a trade when the market price reaches a specific level. It is designed to limit potential losses and protect traders from significant drawdowns. By setting a stop-loss, traders can define their maximum acceptable loss for each trade. Importance of stop-loss orders. Risk management. Stop-loss orders play a vital role in risk management. They prevent traders from losing more than a predefined amount on any single trade, helping to preserve capital for future trading opportunities. Emotional control. Setting a stop-loss in advance removes emotional decision-making during trades. It prevents traders from holding losing positions for too long, hoping for a reversal, and helps maintain discipline in the trading process. Overnight and weekend protection. Stop-loss orders provide protection during periods when traders are unable to actively monitor the market, such as overnight or over the weekend. Selecting the right stop-loss level. Technical levels. Stop-loss levels can be determined based on technical analysis, such as support and resistance levels, moving averages, or trend lines. Placing the stop-loss just beyond these key levels reduces the likelihood of being stopped out by normal market fluctuations. Volatility considerations. Consider the currency pair's average daily range and market volatility when setting stop-loss levels. More volatile pairs may require wider stop-losses to avoid premature exits. ATR, average true range. Using the average true range indicator can help traders determine stop-loss levels based on market volatility. ATR provides a measure of the currency pair's average price movement over a specific period. Understanding take-profit orders. A take-profit order is an instruction to close a trade when the market price reaches a predetermined level of profit. It allows traders to lock in gains and exit the trade once the desired profit target is achieved. Importance of take-profit orders. Profit locking. Take-profit orders ensure that traders secure profits when the market moves in their favor. It prevents the potential scenario of a winning trade turning into a losing one due to price retracements. Removing emotional bias. Setting a take-profit level before entering a trade helps remove emotional bias during profit-taking decisions. It ensures that traders follow their trading plan and don't get swayed by greed or fear. Selecting the right take-profit level. Technical levels. Similar to stop-loss orders, take-profit levels can be determined based on technical analysis such as resistance levels, Fibonacci extensions, or chart patterns. Reward to risk ratio. Traders should aim for a favorable reward to risk ratio when setting take-profit levels. It means that the potential profit should be larger than the potential loss. For example, aiming for a 2-to-1 or 3-to-1 reward to risk ratio. Trailing stop. For trend-following strategies, traders can use a trailing stop as a dynamic take-profit method. A trailing stop automatically adjusts as the trade moves in the trader's favor, allowing them to lock in profits while letting the trade run as long as the trend continues. Managing stop-loss and take-profit levels. Adapt to market conditions. Traders should be flexible and adjust stop-loss and take-profit levels based on changing market conditions and price action. Adapting to the market helps optimize trade management. Avoiding interference. Once stop-loss and take-profit levels are set, traders should avoid interfering with the trade based on short-term market fluctuations or emotional reactions. Trusting the predefined levels is crucial for consistent trading performance. Using trailing stop-loss and partial take-profits. Trailing stop-loss. Traders can use a trailing stop-loss to protect profits as the trade moves in their favor. The trailing stop automatically adjusts to lock in gains while allowing the trade to continue running during a favorable trend. Partial take profits. Traders can take partial profits by closing a portion of the position at predetermined levels while letting the rest of the trade run with a trailing stop. This strategy allows traders to secure some profits while still benefiting from potential further price movements. Conclusion: implementing effective stop-loss and take-profit strategies is essential for successful Forex trading. Stop-loss orders protect traders from excessive losses and emotional decision-making, while take-profit orders secure profits and maintain discipline in profit-taking. By selecting appropriate stop-loss and take-profit levels based on technical analysis, market volatility, and reward-to-risk ratios, traders can effectively manage their risk exposure and optimize their profit potential. Utilizing tools like ATR, trailing stops, and partial take profits enhances trade management and flexibility. Combining these risk management tools with a well-defined trading plan and emotional discipline contributes to more consistent trading performance and overall success in the Forex market.